Hi there, welcome to week 9 lecture. My name is Iji Ogeho. This week, we will continue our consideration of group accounts, specifically looking at consolidated statement of comprehensive income. Last week, we looked at the preparation of consolidated statement of financial position. We will develop that knowledge further this week by looking at statement of comprehensive income. At the end of this lecture, I will reiterate what the purpose of group statement of comprehensive income is. You will understand how to prepare a group statement of comprehensive income. We'll discuss the concept of intra-group items and other adjustments. How do we deal with partly owned subsidiaries? We'll look at also subsidiaries that's been acquired pathway through the accounting period. I will conclude this lecture by looking at group statement of changes in equity. What is the purpose of group statement of comprehensive income? Well, the purpose is the same as that which was considered last week, to look at the profit and loss account of the parent as well as that of the subsidiary as if they are a single economic entity. So IFRS 10 therefore requires that the group statement of comprehensive income should be prepared and presented in recognition of that fact. That is, they are a single economic entity. The importance of this is that a group as one unit cannot sell to themselves or buy from themselves as a unit. So if entity A owns entity B, then they both exist separately as legal entities. When they prepare their separate accounts, they recognize any transactions between each company. However, when we come to prepare group accounts, we will follow the substance of the transaction rather than their legal separate identity. What that simply means is that we'll look at all the group members as a single unit. So if there is a sale between them, that will be eliminated. If there is any relationship in terms of receivables and payables between them, when we prepare the group accounts, we will eliminate such items. It also means that when the subsidiary pays dividend to the parent company, that again will be eliminated upon consolidation. Let us look at this concept a little further. First of all, the group statement of comprehensive income is prepared by adding together on a line-by-line basis the individual items comprised in the profit and loss. For example, we will add the revenue of the parent to the revenue of the subsidiary, the cost of sales of the parent to the cost of sales of the subsidiary, the distribution cost of the parent to the distribution cost of the subsidiary, so on and so forth. However, if there has been any intra-group transactions between them that has been recognized in the individual statement of profit or loss account, then these ones will be cancelled out during consolidation. Let's look at this and consider intra-group items. Intra-group items could arise in so many ways. One way would be where a group member sells some items to another group member. The company that has made the sale will have recognized that sale as revenue. The company that purchased the item, we also recognize the same amount as cost of sales. Whilst this is good from the individual account's perspective, we cannot have that scenario when we prepare group accounts because those two companies are one. Therefore, we must eliminate the sales from revenue and also deduct the sales from cost of sales. Another type of intra-group items that may well arise is interest, where one member loans money to another company in the group. So the company that gave the loan will show receivables in its account, and the company in receipt of the loan will show payable in its accounts. Again, the receivables will cancel out with the payables. However, if any interest has been paid in the intervening period before the loan was received, the company that paid that interest will show it as finance cost, and the company in receipt of the interest will show it as finance income. When we prepare consolidated statement of profit and loss, we have to remove that interest from finance income as well as from finance cost. A third scenario would be dividends. The subsidiary company may have paid dividend to the parent company. Of course, the parent company will show this dividend as investment income, and the subsidiary company will show the payment of the dividend as movements in equity. Again, this dividend will have to be cancelled out when we prepare consolidated statement of comprehensive income. There are other adjustments that we need to bear in mind. Most especially is that relating to sales. Let's take, for example, Company A makes a sale to Company B, and the item sold to Company B was acquired by Company A at £10,000, and this was then sold to Company B at £12,000. That means Company A has recognized a profit of £2,000. Now, of course, if these goods have been sold subsequently by Company B, then we have no problem with that profit. However, if the goods are unsold at the year end, the key here is that if Company B still has the goods at the year end, then it would be on Company B's inventory. Now think about it. If Company A had not sold the goods to B, Company A would have had inventory of 10,000. But now that the goods have been sold to Company B, B now has inventory of 12,000. So which means the inventory is overstated. Because the group are looked upon as a single entity, that profit of 2,000 is unrealized. It is unrealized because it is still within the group. And therefore, when we prepare group account, we must eliminate the profit. And we do so by adding the 2,000 to cost of sales and then deducting it from inventory. By adding it to cost of sales, we have therefore removed the unrealized profits in our consolidation. The other adjustment that we are going to be very, very cognizant of is goodwill arising on consolidation. If you remember last week, I stated that goodwill is never amortized. Under IFRS 3, purchased goodwill will always ever be recognized at cost less impairment loss. So at the end of each year, the goodwill is tested for impairment in accordance with IAS 36. If there is an impairment loss, then that loss must be shown as an expense in the group statement of comprehensive income. Before we look at a set of examples, let me also consider partly owned subsidiaries. This is where we own less than 100%, but more than 50% of the subsidiary. So if the group actually includes one or more partly owned subsidiaries, then part of the profits after tax will be attributable to non-controlling shareholders. We refer to them as non-controlling interest. The amount of profit that is attributable to non-controlling shareholders will be shown separately in the group statement of comprehensive income. As I said earlier, any dividends paid by a subsidiary to its non-controlling shareholders will be shown in the non-controlling interest column of the consolidated statement of changes in equity. Let us have a look at the example, a very detailed example. On 1st July 2017, our Limited acquired 70% of the ordinary share capital of S Limited. There are no preference shares. The retained earnings of S Limited on 1st July 2017, the date of acquisition, were £2,000. The statement of comprehensive income for the year to 30th June 2020 as follows. So you got the sales revenue, cost of sales, gross profit, distribution costs, administrative expenses, operating profit. There is dividend received from S Limited of 14,000. So less your taxation profit for the year. The following figures are taken from the retained earnings column of the statement of changes in equity of R Limited as well as S Limited for the year ended 30th June 2020. You have the balance brought forward of 54,900 for R Limited and 7,000 for S Limited. I'll move myself to this side so you can see that properly. Then the profit for the year is the figure taken from here, which is 146,621,000, less the dividend. Now, of course, if you remember, we own 70% of S Limited. Therefore, 70% of 20,000 has been recognized there as 14,000. We will need to eliminate that in our consolidation process. The following information is also available. During the year, our Limited sold goods to S Limited for 8,000. This good had cost our Limited 5,000. So that means that our Limited has made a profit on this sale of 3,000, which is 8,000 minus 5,000. Now, this profit is unrealized. I insist, the profit of 3,000 is unrealized until S Limited has sold the goods on to third party. Here we are told that at the year end, half of the goods were still held by S Limited, which means half of that profit, 1,500, is unrealized. We have to adjust the cost of sales figure by adding 1,500 to that. Goodwill arising on consolidation has suffered no impairment losses. Prepare a consolidated statement of comprehensive income for the year to 30th June 2020. Also prepare an extract from the consolidated statement of changes in equity showing the changes in the group's retained earnings during the year. Now the process is relatively simple. First, bear in mind that there is a sale between R and S of 8,000. This 8,000 would have been included in R's sales of 624,000. And the same 8,000 would have been included in the cost of sales of S Limited. So we need to eliminate this. The consolidation process is a simple exercise of adding these together line by line. So we would add for revenue 624,000 plus 109,000 less the 8,000 sale to S Limited. As for the cost of sales, we will also add 267,400 plus 65,300 less the same 8,000 of goods sold to S Limited. But additionally, there is 1,500 of unrealized profit in the inventory of S Limited. So we will add the 1,500 to the cost of sales. Let us now look at the solution. Here, just as I said, the intra-group sales of 8,000 and the unrealized profit of 1,500, which is 50% of the profit earned, must be eliminated when preparing the group statement of comprehensive income. Again, the intra-group dividend of 14,000, which is 70% of 20, must equally be eliminated. Now, since we've got 70%, R has 70% of S Limited, then we have non-controlling shareholders who own 30% of the shares in S Limited. Therefore, the profit which is attributable to them is 6,300, which, if we go back slightly, is the profit of 21,000 at 30%. So they have a share of that profit. So you see that we have actually added the items together line by line, less the 8,000 sales, and in the cost of sales, again we deducted the 8,000 there, which is the sales value. The same amount, and I repeat, the same amount is deducted from revenue as well as cost of sales. Then we add to it the 1,500 that was calculated earlier as unrealized profit, being half of the items sold to S that still remains in stock. That gives us a gross profit, and the rest of the exercise is a simple adding of items together on a line-by-line basis. And so we have a total here of 152,100, which is the profit for the year. But that profit for the year of 152,500, we need to explain the makeup of it. Well, as we said earlier on, 30% of the 21,000 profit after tax figure for S Limited belongs to non-controlling interest. And so we need to show that separately, which is 6,300. The difference between 6,300 and the 152,100, which is equals to 145,800, will be the profit attributable to the parent company. As you can see, the two adds up to 152,000. As far as the group statement of changes in equity is concerned, we'll take the balance at the start of the year, which we'll look at in a minute in working one, of 58,400, and then add the profit attributable to the parent, which is this one, of 145,800, and then deduct dividends paid by our limited only. If we deduct that, the final balance is 84,200. This is the figure that goes to the retained earnings section of consolidated statement of financial position. Let's look at the two workings. The workings for the retained earnings brought forward and the retained earnings carried forward. Let's look at the first working. How did we do this? Well, if you must remember, looking back at the question, we have the opening retained earnings of 54,900. That belongs to R Limited. We also have the retained earnings of 7,000 for S Limited. But of course, that includes the pre-acquisition profit of 2,000. So if we deduct 2,000 from 7,000, that means they have earned extra 5,000 since acquisition up to the start of the year. And of course, of the 5,000, we've got 70% thereof. Let us see that. So you can see that we've taken the retained earnings of the parent and the retained earnings at the beginning of the year for the subsidiary of 7,000, less the subsidiary's earnings at the date of acquisition, hence 5,000. Our share of that is 70%, which is 3,500. Adding that to the parent, the group's retained earnings brought forward is 58,400, just as it is shown here. What about that which is carried forward? Again, we can use the same information provided here. So, if we have the retained earnings for the period, the balance carried forward for the parent is 81,500. For the subsidiary is 8,000, but of course 2,000 of that is pre-acquisition, leaving post-acquisition profit of 6,000. We have 70% of that 6,000. And then we need to deduct from that the unrealized profit of 1,500. So there we are. The retained profit for the parent is 81,500, and that is the 8,000 for the subsidiary, less the profit at the date of acquisition, and so we have 6,000 post-acquisition profit. 70% of 6,000 is 4,200, less the unrealized profit of 1,500, that gives us 84,200. That is how we prepare consolidated statement of comprehensive income. There will be more exercises to do during this seminar, so make sure that you read this and you follow these examples carefully. You have more time to ask me questions during the seminar sessions in our online sessions. Before we conclude this lecture, let me very quickly look at some other aspects that we will have to deal with during the seminar. What happens if you acquire a subsidiary through an accounting, partway through an accounting period? The issue here is to try and differentiate between pre-acquisition profit and post-acquisition profit. If I take you back to the last exercise we just did, you will realize that it is only the post-acquisition profit that we add to the group reserves. Now, of course, the pre-acquisition profit was given to us because the acquisition was some year hence. However, if the acquisition is in the current year, we know that the profit retained at the start of the period is definitely pre-acquisition because we have not had any stake in the subsidiary at the beginning. What about the profit during the period of acquisition? Well, the simple thing to do is to assume that the profits for the subsidiary accrue evenly throughout the period, although that is not necessarily the case. But for simple consolidation, that assumption is made. What that therefore means is that we would take the profit and prorate it. In other words, take the proportion that belongs to the period before acquisition, and then the proportion that belongs to the period after acquisition. I'll give you an example. So, supposing we are looking at a company that was acquired on the 1st of April. This means that 3 months of the profit for that year is pre-acquisition profit, and 9 months is post-acquisition profit. So when we prepare the consolidated statement of comprehensive income, we will add the items on the line-by-line basis, beginning with revenue. We'll take the revenue of the parent plus 9/12 of the revenue of subsidiary, because we've only got the subsidiary for 9 months. We will also take the cost of sales of the parent plus 9/12 of the cost of sales of the subsidiary. And all the items will simply be 9/12. The group share of the subsidiary's pre-acquisition profits, in other words, 3/12, will go into the goodwill calculation. And the share of the post-acquisition profit is added on a line-by-line basis in the consolidated statement of comprehensive income. Group changes in equity. The group statement of changes in equity is a little bit more involving. Again, we are looking at this from a purely simplistic perspective. It will show how each component of the group's equity shown in the group statement of financial position has changed during the accounting period. Normally what happens is that there is one column for the parent's share capital and then one column for each of the group's reserves. These columns are then totaled to show the equity which belongs to the parent shareholders. Then we have a further column for the non-controlling interest. And after that, a final column which adds up the non-controlling interest with the previous total to show the total equity of the group. We will discuss this further and use examples to illustrate this during our seminar. In summary, this week we have looked at consolidated statement of comprehensive income. And we said that this shows the profit or loss of a group as if they are a single economic entity. And we prepare it by adding together line by line the individual items in that statement. Intra-group items such as sales, interest, or even management expenses between the group members, although valid for the individual company accounts, but we must cancel them out on consolidation. Any dividend paid by a subsidiary to its parent is also cancelled out against dividend received, such that only the dividend payable by the subsidiary to non-controlling interest shareholders will remain in the group statement of changes in equity. Impairment losses are shown as expense in consolidated statement of comprehensive income, just as depreciation adjustment arising from fair value in fair value adjustments on consolidation. The part of the subsidiary's profit that is attributable to non-controlling interest is shown separately in the group statement of comprehensive income. If a subsidiary is acquired partway through the accounting period, then the profit for that period must be apportioned between pre-acquisition and post-acquisition. And remember, the pre-acquisition part of that profit will be used in goodwill calculation. and the post-acquisition profit will be included in the consolidated statement of comprehensive income. I hope this lecture helps. We will emphasize and reiterate most of these points by way of examples during the seminar. Please make sure you read your textbook before coming and look up the materials on Moodle prior to coming. I will upload the same materials on Microsoft Teams for our collaboration. Thank you for listening. Stay safe and have a good time. Thank you.